Good morning and welcome to the SimplyBiz webinar, Finding the Balance in Partnership with Credo. My name is Amy Whitworth and I'm the Events Project Manager from SimplyBiz, and today we're joined by Ben Newton and Damien Yeomans from Credo. This session will discuss how the art and benefits of diversification in portfolios are becoming harder to achieve in an environment of low and negative interest rates. So before we get started, we have a few housekeeping rules to cover. So this presentation can be recorded as structured CPD, and copies of the slides will be sent to all attendees after the session, with the CPD certificate sent to those who remain dialed into the session for over 30 minutes. If you have any questions about the session, these can be submitted in the questions panel on the right hand side. I'll ask these to Ben and Damien at the end of the session. After the session, we'll also provide you with the opportunity to give content and presenter scores and give written feedback once the session is closed. And I'll pass you over to Ben and Damien to begin. Thank you.
Thank you very much, Amy. On behalf of Damien and I, a big welcome to this event today from SimplyBiz, and thank you for SimplyBiz in helping organise the event. So as Amy mentioned, I'm here today to talk to you about finding the balance between attractive returns and sufficient diversification in the current interest rate and investment environment that we stand in today. For those of you who don't know, Credo was started over 20 years ago, and the UCITS funds were actually started just over 3 years ago in July 2017, and they were born out of this really strong track record of underlying segregated mandates. Credo currently have over 3.8 billion assets under administration, and as of yesterday, we have 100 staff, showing that we're a growing, strong organisation. Our staff are split between London and South Africa, with all investment decisions made out of London. I joined Credo just over 6 years ago. Prior to joining Credo, I was a discretionary portfolio manager at Barclays Wealth. I joined Credo to have more influence over the investment decisions, and at Credo I have co-responsibility over our fixed income strategies and Credo Dynamic that I'll mention throughout today's presentation. As Amy mentioned, what we're going to discuss today is how a true diversification in investment portfolios is becoming slightly harder to achieve in the current investment environment, how we can still make some attractive returns, albeit in a low interest rate environment in fixed income assets, how to achieve diversification in equities even though indices are becoming slightly more concentrated, and the importance and the case for alternatives in multi-asset portfolios. This is a pictorial diagram of our agenda, and it will signpost you through today's presentation. So where have the benefits of diversification gone? We're starting off by showing this diagram here. It's got volatility or risk on the horizontal axis and return on the vertical axis. This is a traditional diagram you may see in the textbooks or any studying of finance, and one may have seen an efficient frontier drawn between the dots to show an optimum portfolio, but that will come in a later slide. The first thing that stands out to me when I look at this presentation and diagram over the last 20 years is that sterling high yield has actually been the best returning asset class to be invested in. Traditionally, you may have thought that might have been developed equities. Additionally, global corporates and UK corporates have delivered a very attractive 6%, and fixed income as a whole has delivered a really attractive risk-adjusted returns to our portfolio, partly helped by the decreasing of interest rates. On the right-hand side of that diagram, you can see developed equities and UK equities. UK equities have underperformed global peers, but even developed equities have returned similar to that of the broader fixed income market, but for significantly more risk when you take into account the financial crisis. Focusing now on about the last 10 years of data that we have, so the previous diagram is 20 years, we're now looking at just over 10 years of data here. you can see that developed equities are very much top of the pile. Developed equities have returned over 11% over the period, and that's why they're being very much talked of and the key asset portfolios. This diagram here shows all the different asset classes in sterling color-coded and illustrates how some asset classes can come top and bottom of the pile in consecutive years. That's best illustrated by the dark blue box of UK REITs. Very much in and out of favour, whether it's political risk, Brexit, or the underlying fundamentals with retail shops and offices, causing it to be top and bottom of the pile. And interestingly, overall, it comes out around middle, but very much, maybe some active decisions could have very much added value there. And finally, commodities, traditionally part of a multi-asset portfolio, has been a significant drag in most years, returning -3% since the inception of this period, and very much bottom of the pile, as I said, on most years. The reason to invest in fixed income assets, traditional government bond assets today, is the negative correlation between stocks and bonds. So in a year where equities haven't performed or they've actually been negative, because of a risk-off environment, you would potentially expect that government bonds will deliver a positive return. This graph shows the correlation between those two assets going back hundreds of years. One can see that actually the decrease in correlation, which turned negative only in the 2000s, is illustrated on the right-hand side. So what that's showing me is that this actually is a recent phenomenon, which has only actually lasted around 20 or so years, and that's partly as a result of the increasing importance of monetary policy and decreasing interest rates. And therefore, that's not something we can necessarily rely on, given the long-term history. As I said, it's worked in recent years. You can see this year, global bonds are top of that pile, or top of the pile of the table that I showed you just a couple of slides ago. Coming into 2020, very few people would have predicted that global bonds in sterling terms would have returned about 8% as the beginning of November. Developed equities were pretty much flat overall. It's really been the story of recent years. When equities haven't performed, bonds have turned up to the party. Look at 2018. Once again, bonds positive almost 5%, developed equities negative 3%. And going all the way back to 2011, bonds plus 6%, developed equities minus 5%. So in recent years, it's worked. However, we can't be assured this is going to happen every single time going forward. Going back to my efficient frontier, I mentioned it again a couple of slides ago, drawing that risk-adjusted return with risk on the horizontal axis and return on the vertical axis. It's a slightly messy slide, and I'd like to apologize for that. But what it's showing is that each different decade, there's a different optimum portfolio, a different balance between investments. And what that means to us is therefore in each different investing environment, we have to be adaptive to our current surroundings and change our outlook, our asset allocation. So that's giving you an overview and a broad view of a portfolio. But if we dig down slightly deeper by each individual asset class, we're starting with fixed income. So as you can see here, global government bonds have significantly reduced their return. So on that first slide, I said government bonds returned around 6%. And that's the same as a 10-year government bond, which is shown here in all those different lines from different countries in the early 1990s. So we have the UK, Germany, Japan, Canada, and the US. And the trend's pretty much identical, top left to bottom right. Historically, they returned about 6% to investors. And if you fast forward all the way to today, the 10-year government bond in sterling terms, for UK government bonds that is about 0.35%. In many other countries, Japan, Europe, is negative. and who knows what the outcome may be. What we can say is after any form of fees to underlying clients is unlikely to produce a significant positive return over the long term. Yes, we may have years that will be positive. What we know is we're guaranteeing zero return over 10 years. So what excess return can we earn from buying credit? This is shown in this graph when the data goes back to only 2012 for sterling investment grade and high yield credits. Investment grade in that blue line shows that in the early period it was about 2% over government bonds, and today that's about 1.3%. It's traded in the range of 1 to 2%, and therefore on a relative value perspective, compared to government bonds, we're still earning within the range of normality of returns when everyone is talking about expensive assets. If we look at high yield, it took a while to normalize after the financial crisis. So in the beginning of the period, you're earning over 8% extra return over government bonds. That quickly normalized by about 2014, and the range has been approximately 4 to 6% over. Today, that's about 4.5%. So again, towards maybe the bottom end of that range, but it has traded, at 3% for a number of times within the period. So that wouldn't be out of normal. So there we can say we're still earning 4.5% extra over government bonds, and we think relative value shows us that it's okay, and it's not overly expensive like some of the other asset classes. What's actually important to note, and highlighted on this slide though, is that in March we saw a big sell-off, a big jump up in those yields. Although there wasn't necessarily a significant underlying fundamental problem with underlying credits, high yield can act a little more like equities. And when there's a significant amount more sellers than there are buyers, it's a less liquid market, and prices can fall subsequently. This was rebounded very quickly and was only a short-term thing, and therefore it's a consideration when investing in high yield, but we get very much excess return for it. So we've talked about the excess return from investing in credit. What is the risk? The real risk is the chance of default of the credit. So I've taken this data here from S&P, which goes back about 30 years. This is the chance of default if I'm buying a credit of a certain rating today. The blue names on the right-hand side, or the letters on the right-hand side, illustrate the blue ones are investment grade, the black are high yield. So we take the line of BBB, which is a brown color. You go out 10 years, you can see that the chance of default of just picking any random bond going back over the last 30 years is about 3%. So at Credo, we think we can outperform this, and subsequently, we rarely invest in A-rated names unless it's really appropriate for the clients and within their requirements, because we think there's a lot better risk-adjusted return owning BBB. A small amount extra risk, a significant amount extra return. Again, in the same light, we don't really invest in the main in single B or C-rated credits because the risk of default is actually quite significant. You take a 3-year C-rated name and you jump to almost 40% probability or empirical evidence shown of default. And so when we're talking of high yield, we focus on BB. We go out 10 years, there's about a 10% chance of default. But within Credo income portfolios, we have not had a bond default over our track record. We think we can outperform this. We think there's active management, selection, very much watching the underlying companies. If we see a deterioration in credit rating and fundamentals, we're quick to move on. So as investors, we focus on that BB, BBB space for the excess return earned, and we think it's a really attractive risk-adjusted return where we can add significant value. So what does that mean for our portfolio within Credo Dynamic? We invest about 1/3 of the portfolio in fixed income. It has a really attractive return of over 6%. When we're investing in more high yield credits, we prefer a shorter term horizon because there's not so many variables that can take into consideration. We're more likely to be repaid. And additionally, we like to buy some high quality short dated credits to reinvest the proceeds in different assets so we can always have liquidity to the portfolio. But when we find the right credit, we're happy to take longer term risk because we get paid more for it. We're sterling investors, so a significant portion, if not all, almost, of that fixed income portion will always be in sterling. And we'll go to other asset classes and other currencies when we actually see the greater opportunity or a special opportunity. So our fixed income assets are always going to have that core of sterling bias. A key example that brings the portfolio to life is this cooperative bond. It's just under 4% of our portfolio today, and it's been invested since we started the fund in July 2017. It's got 5 years to maturity, and it yields over 5% today. So the future return today is over 5%. The company is your local funeral provider, or your local cooperative store, your convenience store on your local high street that has really benefited from people being out of the home less and eating out less as a result of the pandemic. It's a consumer staple product, so it enables the company to have less volatile earnings, which is important from a fixed income investor. It's got a very experienced management team. It's been around for over 175 years, and we get paid over 5% as long as it survives the next 5. All of our evidence, all of our research, we believe very strongly in this thing. Changing asset classes and moving on to equities. You can see here, I've taken a graph of the S&P 500's top 10 holdings weighting going back to 1985. One can see that the standard range or the approximate range over that period is typically 18 to 20%. That was only eclipsed in the early 2000s as a result of the tech boom that touched 26%. Quickly normalized to its regular levels until around this year, where it surpasses for the first time ever. So therefore, the S&P 500 has actually the least diversified it's been in its history. And that's something to take into consideration when investing. This is slightly better shown within this diagram here. So here we've got those big names, the Apple, Microsoft, Amazon, Facebook, and Alphabet you read a lot about in the press. They make up a large portion of the index, over 22.5%, and this is just the top 5 names, not the top 10 I mentioned on the previous slide. They've got the same weighting as the bottom 355 companies. So when you think you're buying the S&P 500, you think you're getting really a significant exposure to 500 names. Really, you've got a core exposure to just a few. They've performed brilliantly to date, and I'll show you that on the next slide. But we think there's a risk, and the law of large numbers, it's harder for large companies to grow at such a large level, and the concentration is quite high. So we've taken a portion, almost half of our S&P 500 exposure, switched it to an equally weighted index to ensure diversification for our investors. And it also illustrates the choice when you're looking at a multi-asset portfolio of the underlying investors and underlying indexes that you can invest in. This here, as I mentioned, shows the return. So the S&P 500 this year, the blue bar shows just the top 5 names. They've delivered all of the return of the S&P year to date. Maybe this week we've had some level of rebound in other names, but the majority of the returns all come from those very small number of names. This is very odd when you look at the recent history of the last 10 years. Only in 2011 has the blue bar taken up most of the portion, and that was a very small number. So it's just something to highlight, something to consider when investing. We're not going to say those companies aren't brilliant companies, but at the same time, we always want to ensure diversification. This graph here, I've got at the S&P 500 and comparing it to the market cap of the broader global markets. The S&P 500 is incredibly important for the MSCI World and the broader indices, and is a very large weight. But actually, when you compare, and excuse the pun here, but it's kind of an apples and pear comparison if I use Apple, but Apple's almost got a similar market cap to the Ftse 100 or even the global indices like Japan, France, Germany, and Hong Kong. But if I, as I say, compare Apple to Ftse 100, it's not like for like, but I just want to illustrate here the valuation differences. So Apple's got a market cap in sterling terms of 1.4 trillion pounds. The Ftse 100, of a group of 100 companies, including great names like AstraZeneca, Unilever, Diageo, HSBC, Prudential, might not be the highest growth companies or most exciting companies, but a very established name and very large companies that you can rely on, have a market cap in aggregation of 1.5 trillion. So Apple with 1.4 trillion, Ftse 100 1.5 trillion. For growth, you might always back the more exciting Apple, which is those brilliant products and brilliant balance sheets. But it's very hard to comprehend that they're almost a similar equal value. Additionally, when you're investing abroad, one has to consider what that means for a sterling investor. There's going to be currency risk. It's very hard to predict. I'm not going to make any political predictions here today. But what we can say is over the history and looking back over the long term, sterling is relatively undervalued on all metrics. It all depends on the Brexit outcome, but that's a risk. It can be risk that can go either way. But as investors, we want to manage the risk. We want to ensure diversification. So we portionally have hedged a part of our international equity exposure to reduce that risk to our investors. Additionally, I think it's probably slightly overlooked when people focus on the large returns that have come from those top 5 or so companies in the US. Small companies have empirically outperformed over the very long term. This is a graph that goes back almost 100 years. It shows on the right-hand side the largest companies and the left-hand side the smallest companies. You can see here the largest companies return 11%, and there's a sloping graph up to 17% for the smallest companies. So there's an excess return to be made by investing in smaller companies. It makes sense. Smaller companies, smaller base, so the percentage growth can be easier to achieve. Additionally, we think it's an area we can add value to as investors. We can, go out there, pick stocks that are under-researched, overlooked. It actually provides further diversification to a portfolio because they're less correlated to the broader markets. And we think this is a really important part of a diversified portfolio. So how do we invest in Credo Dynamic? About 50% of the fund is core and invested within equities, and splits between large cap and exposure to SMID, where we can add that value. We meet companies weekly and daily looking for those uncovered gems. We also acknowledge the importance and the great companies there are globally, and therefore the equity allocation is somewhat split between the UK and overseas. We utilize some collectives as well, and one of our favored ways of investing in collectives is through investment trusts. We think, again, this is a portion of the market that we can add value in, and again, I'll mention investment trusts in the coming slides. I said small cap, and nothing brings to life small cap than an actual example. Team 17 has been a firm favourite to Credo Dynamic since we invested in May 2018. It's been a 4-bagger for the fund. And what Team 17 originated was from Worms, the game Worms, but it's grown into a games developer, a games label, a bit like a music label. Here you've got a team of panelists that are picking games to invest in and third parties, and it's really been a great company to invest in with an inspirational management team. Additionally, it's benefited from the pandemic People are staying at home more, playing more games, and that's why we've also invested in the broader sector 2020. But importantly, there's a console launch this year. Both console launches are the two main brands, and Team 17 have accompanied this with 6 new of their own label games. So people are staying at home more, there's new consoles, there's new games. We're hoping for a bumper Christmas, and hopefully this will continue to deliver strong returns to our clients. I mentioned investment trusts. Investment trusts are companies that trade on the market but underlying their portfolio of assets. This can be anything, and we'll come on to this in the alternative space, but also equities. There's a track record of long-term outperformance. Managers don't have to focus on the kind of flows within the fund. They're focusing on the underlying performance and relative value. Additionally, they have the ability to use gearing if necessary or if required. And there's a number of specialty managers that launch strategies in this manner. Allianz Technology I've shown on this slide. This is a manager that's outperformed the NASDAQ over the long term, invest in not only large cap but mid cap technology names. So it's got an area of expertise where we think they can very much add value. So it's been on our watch list for a long time. Technology in this current era is very important. And in 2020, we took the opportunity to add to Allianz Technology in the time of distress in March. So the graph is a little complicated, so I apologize for that. The blue line is the underlying share price. The red is the underlying asset value of its portfolio. I'm going to put that to the side for 1 second and focus on the grey. The grey is the difference between the blue and the red line. If we quickly fast forward to March, you can see at a period of dislocation in the markets, asset prices were falling. There were more sellers than there were buyers of this share, Allianz Technology. We could buy assets at a great price, but actually 10% below their underlying asset value. And therefore, we call this a double discount. We're buying assets that have fallen in the underlying market and a share price that's fallen more in a management team that we back. We like to invest in the long term. And this is the type of things we look to add to, and we're long-term believers. Moving on to alternatives. We think alternatives are very important, especially when you haven't got that bedrock of interest coming from government bonds. This graph here, I've reverted back to my efficient frontier, volatility and risk on the horizontal, return on the vertical. The blue dots look at traditional assets, equities, bonds, some property in there, and that comes together to an efficient or an optimum portfolio of the green line. Here you can see all the different returns available for the different risks you're willing to take. But if I add some alternatives, I've used examples just for this, like hedge funds or private equity, just to illustrate my point. But one can see if we add alternatives to a portfolio, because of the diversification benefits, because they're high returning, they actually increase the return for the same risk. We think that's very important and something that we're looking to achieve in our portfolio. So how do we invest in alternatives? Because alternatives can be a very murky space. We invest in liquid, daily traded, so that's a very important place to start. Makes up over 13% of our portfolio and traditionally wavers around that 15% level. There are 11 underlying holdings. All of them investment trusts, apart from the one ETF. The ETF is gold. We're not necessarily gold bugs. We're not necessarily going to be those long-term investors in gold. But given the short-term noise within the market, the risks on the market, the news out there, we think it can be an important time in these uncertain times. And especially when there's a zero opportunity cost as no interest rates available for government bonds. So we think as a diversified portfolio, it's an important little holder, but at the same time, we're conscious that it's a low returning asset over the long term. The rest of the alternatives, you're in high returning assets in their own right, typically income producing, you have a low correlation to the broader portfolio. So what does that mean? We invest in infrastructure, we invest in royalty income, and also music royalty income that I'll show you on this next slide. We think this is a very interesting asset. It makes up just over 2% of our portfolio. And what it's based on is you're earning money every time something's played on Spotify or someone's performs a song. You have that intellectual property right. Why do we think it's interesting? Well, it's been a long track record within the global recorded music revenues, the industry themselves. And it's been a story to tell. In the early 2000s, everyone was buying CDs. That quickly changed and people started downloading illegally online, and the revenues of the industry started falling considerably. That all turned when the blue portion of that bar chart appeared in around 2012, 2013. It's been significantly growing ever since. That blue portion is streaming. People now don't buy songs on iTunes, they don't buy a physical CD typically, they stream it. And what that means is less and less people are downloading illegally. The revenues of the industry are growing significantly, and the blue portion of the pie is such a large weighting that growth is coming through to the broader revenues. Streaming revenues are growing at 35%. It's a liquid fund. We can earn just under 5% income yield, but we've got the growth angle there. Additionally, people play songs where they're happy or sad, where the economy is going well or bad, and therefore we think it's a really interesting part and an interesting asset to earn in a diversified portfolio. So I've mentioned Credo Dynamic a few times in our presentation, but I wanted to touch on now actually a little more about the fund. So Credo Dynamic is aiming to achieve equity-like returns for lower volatility. We invest in both direct and collective, as I've mentioned throughout this presentation. So the direct investments will invest in the likes of Team 17, the likes of cooperative, and all of our fixed income investments. We will selectively use collectives where we think that the alternative is better, the diversification is better. And alternatives which we have to use third-party managers. We have a flexible approach to investing. We invest in a very broad universe. And we're core to our idea and our sterling bias. What does that mean? As I've shown you throughout the presentation, we've got about 50% in equities, a third of the portfolio in fixed income, with a balance in alternatives. And our currency weighting on the slide here is 57%. That typically ranges between the 55 and 70% range, depending on our outlook, depending on the opportunities we see. And we're core to our retaining that over 50% weight in sterling assets. How have we done since our launch in July 2017? Well, we've outperformed our peer group by just under 4% over the period and maintaining outperformance for long stretches since our inception. Having said that, we think this is even more impressive when one considers that today about 20% of the portfolio is invested in UK equities, but it's been at a maximum of 40%. UK equities over that period have lost you over 11%. So therefore, we're outperforming our peers when there's been a drag on the portfolio. And where we think when at a period where this drag reduces, we can significantly increase our outperformance to our peers. And we're looking forward to this time, and we still believe in our core strategy that delivers alpha to our investors no matter the investment environment. Here I've got a pictorial of all our platforms that Credo Dynamic is available on, and Damien will be available about any questions with regard to this. So what have we discussed today? We've discussed that we don't think fixed income needs to be boring. We can find high yielding in special situations, even in the current interest rate environment. We think there can be a really attractive risk-adjusted return still to be earned. Equity markets have recently been driven by a very narrow number of stocks. And therefore, one's got to keep the importance on achieving diversification and looking at under the bonnet of the indices we invest in. We think UK equities are broadly overlooked in the terms of especially the small cap space. They're uncut gems, there really are great companies we can still find no matter the overall environment. And we think smaller companies will help to deliver a really attractive return over the long term. Alternative assets remain a very important part of a diversified portfolio, especially if you're not getting that guaranteed return from the traditional government bonds. And finally, we think a flexible approach to investing and an investment which can have the oversight of different asset classes is very important to have today. As I mentioned, my colleague Damien is available to questions. He's a sales representative for Credo UCITS funds, and his details are there for future contact. And once again, I'd like to thank you very much for attending our webinar, and Damien and I will be available to take any questions.
Thank you very much for joining us, and thank you to Ben for an informative session. So just to reiterate, we'll be sending out copies of the slides to all attendees after the session, with the CPD certificate sent to those who remain dialed in for over 30 minutes. So should you wish to view the webinar again, a recording will be available to view on the Advisor Media Player under the Investment section in the next 7 days. So we've received a few questions so far. So the first one is from Josh. So what percentage of funds is invested directly rather than through collectives?
Thank you, Josh, for your question. As I mentioned, we have a balance between collectives and direct investments. We always prefer to go direct. That's the important mantra we start with. We will only go direct where we can think we add value and that there is something there that we're very comfortable with and we're experts in. If not, we'll look to first point of call be a low-cost alternative like an ETF. But in ETF, there's still a very broad choice. I mentioned the S&P 500 equally weighted. And additionally, we'll only use an active manager when they've got a great track record and something we can't replicate by an index. So that's kind of a long-winded way of saying we have about 60% in direct, 40% within the collectives. But remember, within that, we include things like alternatives, which would always be a collective and something we would rely on third party for. Thanks again for the question, Joshua.
Thank you. And the next question is from Steve, who asks, does the fund have a de facto risk rating?
Thanks, Amy. It's Damien. Yes, I'll be happy to take that one. It does have a de facto risk rating. Yes, it's rated as a 5 out of 10, so deemed as suitable for balanced investors.
Thank you very much. We haven't received any further questions, but if you do have any after the session is closed, please forward these over to us and we can send them on to Credo. So after the session, you'll be prompted to provide content or presenter scores, as well as answer further feedback questions. By providing scores, you help us shape the future content for our webinars. We hope you found this webinar useful and relevant to your business needs, and we look forward to you attending one of our events or webinars in the near future. We do welcome any feedback you have on our webinar, so please do let us know if you have any comments. And thank you again for attending.